Hi everyone, I hope you're all doing well. Welcome back to the channel. In this video, I'll discuss the effects that reinvesting dividends can have on your stock portfolio, showing you theoretical and real-world examples of this phenomenon. Reinvesting dividends is one of the most powerful and reliable strategies available for boosting stock portfolio returns over time. Once investors receive a cash dividend, they must choose to use them to purchase more shares to trigger the start of a process Albert Einstein called the eighth wonder of the world, the miracle effects of compounding. Compound interest, put simply, is interest on interest, and it can help an investment grow at a faster rate. By reinvesting dividends, you give your stockholding the potential to earn even more dividends in the future. The idea behind dividend reinvestment is that you receive dividends, then you use the dividend to purchase more shares that pay more dividends, then you use the dividend to purchase even more shares that pay even more dividends, and so on and so on. As this process is repeated over time, a small initial sum can eventually become much, much larger as the compounding effect takes hold. This type of growth is often referred to as the snowball effect of dividend investing. Imagine the image of a small snowball rolling down a hill. It might not be very big at first, but as it rolls down the hill, more and more snow gets added to it, and therefore, its size grows larger and larger. The bigger the surface area of the snowball, the more snow it picks up along the way. This same principle holds true when following a dividend reinvestment strategy. Our positions keep growing larger and larger each time a company pays a dividend, and therefore, the larger our total number of shares, the larger the dividends will be. This is a process that requires a long-term timescale. It's definitely not a get-rich-quick scheme. Time does all of the work. But some people often get discouraged or unsatisfied by a lack of early results in their investments. Just to reiterate again, this is a long-term route to increasing wealth. A great illustration of the snowball effect of compounding is to look at Warren Buffett's net worth by age. As you can see, he starts off with a relatively modest amount, but then as the years go by, his net worth increases bit by bit. Then, at around age 52, it seems to just take off like a rocket. But why is this? Well, the more assets he has, the more wealth he creates, and the more wealth he creates, the more assets he can buy. Buffett actually bought his first share at 11 years old but has earned 99% of his wealth since his 50th birthday. This is the point I'm making about compound interest. It starts off slowly, but then over time, you see the effects really ramp up and produce pretty amazing results. So, how can this work for us? Firstly, I'm going to talk through a simple theoretical example just to illustrate how this can help our dividend portfolios. Then, I'll go through the same process again using an actual real-world example. To initially explain this concept in theory, let's say a share costs $10, and you own 10 shares, and the company pays a dividend of $1 per year per share, and the share price remains constant. A 10% dividend yield is much higher than most stable dividend-paying companies, and it's highly unlikely that a share price won't move. But we'll use easy numbers just to demonstrate the concept. At the end of the year, your 10 shares are still worth $100, but you've received 10 lots of $1 in dividends just for holding the shares. As the share price is still $10, you can then buy another share with your dividends, effectively for free. So now you've got 11 shares and will be paid 11 lots of $1 in dividends. At the end of that year, your holding has grown to $110, and you've been paid 11, so you can purchase another 10 shares. Stick a few zeros on the end of these numbers, and you can appreciate how this method can really supercharge your returns. That was just a simple theoretical example, but how does this look in reality? This is a chart I created using data on Coca-Cola's dividend payments and average share price from 1988 to 2019, assuming a $10,000 initial investment. The blue area represents someone who didn't reinvest their dividends back into their portfolio, and the orange line represents someone who did reinvest their dividends back into their portfolio. You can see that initially, the gap between the blue area and the orange line isn't that great. But then over time, this gap widens and widens as the dividends get reinvested into more shares. Those new shares pay more dividends, and this speeds up the compounding process, as we mentioned before. It's like earning interest on interest. As we get to around 2011, 2012, things really seem to take off, and the trajectory of the line gets steeper and steeper. This symbolizes the snowball effect I talked about earlier. Stop for a minute to imagine the path of the orange line if it carried on for another 10 years. During this period shown on the graph, the blue area's initial investment of $10,000 would have grown to a market value of around $211,000 while receiving $81,000 in dividends over the years, for a total of $292,000. Whereas, in the orange line, the initial $10,000 would have grown to a market value of around $418,000 with dividends reinvested. The difference between reinvesting dividends and not reinvesting dividends is a pretty hefty $126,000. This portfolio would then be paying around $13,000 in dividends every year thereafter, whereas the non-reinvested portfolio would be paying around $6,000. So, if we look at the data table behind this graph, we can have a closer look at the dividend income. If we reinvest dividends in the first year, we start at around $306 in yearly dividend income. This doubles to $617 4 years later, then doubles again to around $1,200 4 years after that. To see the snowball effect in full flow, let's focus on the changes in dividend income year on year. We can see that the first 15 years or so average around $100, whereas the last 8 years are averaging nearly $900. It's worth noting as well to see how many more free shares we can buy each year just by reinvesting dividends. You can really see how the new shares column takes a few years to get going, then really ramps up towards the end. If we look at the final number of shares that we're left with, we can see that we've effectively doubled our initial holding just by reinvesting dividends. Let's just take a moment to reiterate what's happened here again. So, in 1988, you initially put $10,000 into the market. Then in 2019, without investing another dollar, you receive more than your initial investment in yearly dividends for as long as you hold that stock. That was just an example with an initial investment of $10,000 and no further capital investment. But what would happen if we were to keep depositing regularly throughout the years? Let's take a look. I've used a modest capital investment of $6,000 per year or $500 per month. I've also discounted the figures through an inflation calculator, as I appreciate that $6,000 in 2019 isn't the same as $6,000 in 1989. If purely reinvesting dividends produced impressive results, investing a capital amount of just $500 a month absolutely skyrockets the returns, doubling the previous final total to nearly $974,000. Let's look again at the data table behind the graph. We can now see that this portfolio was producing yearly dividends of nearly $30,000 compared to the $13,000 from just reinvesting dividends alone and $6,000 without reinvesting dividends at all. I find it really interesting that the dividend doubles again after 4 years, from $306 initially to $685, the same as the previous example. However, by 2006, we would now be earning double the yearly dividend just by consistently investing $500 a month, $3,200 versus $6,500. Then we see the snowball effect once again towards the end of the period. Let's again focus on the changes in dividend income year on year. We can see the first 15 years or so average around $225, compared to $100 previously, whereas the last 8 years now average around $2,100 compared to $900 previously. If we also look at the final number of shares we're left with again, we can see that we nearly have 5 times our initial holding. I do appreciate that Coca-Cola is a great performer over time, regardless of dividends paid, but running the numbers behind the theory holds true for many other companies. The fact is that dividend reinvestment will boost your returns over time, sometimes quite dramatically. The key element to remember behind this theory is time. The compounding effect only gets stronger with time. This is a long-term process, and the earlier that you can start, the better. There's a really good quote that I like that says, "The best time to plant a tree was 20 years ago. The second best time is right now." I hope you found this video useful and informative. If you have, then please like the video and subscribe to the channel.